And today I have Dave Bookbinder with me, and it's a great pleasure to speaking with him. We'll be talking all things small business, enterprise, as well as valuation of your company. What is your business really worth? And if you have a team of people, we're going to talk about return on individuals, people, right? So let's talk about that. Let's get into this. Dave, welcome to the Business and Wealth Show.
Hey, it's my pleasure to be here. Thanks for having me, Mac.
You are most welcome. Dave, why should someone stay and listen to what we're going to talk about in terms of business valuation? What is your business really worth, and how can you get the most return on your investment, both in terms of the monetary side of it, and later on when we talk about the people side of things?
Well, great question. So, why should people continue to listen? Okay, here's my best shot at that. Recently saw an article on CNBC that said that 98% of business owners don't know what their business is worth. I've been in the business valuation consulting profession for a very long time, and I can tell you firsthand that most business owners really don't know the value of their business. So, if you're one of those folks and you think you know the value of your business because somebody told you at a cocktail party that you were worth 8 times EBITDA, you may want to tune in.
Definitely true. Listen, Dave, again, thank you for jumping on. Tell us a little bit about your entrepreneurial background. I know you had many years in corporate before you set out on your own. So tell us a little bit about that journey and how did you start your own enterprise?
Well, I'm with a firm called Hafley Flanagan. I lead the valuation practice there. We're an accounting firm here in New Jersey. And I guess the entrepreneurial journey aspect of my career is as a practice leader and growing up in the ranks of employee to leadership to being responsible for teams and practices and things like that. So it's been an interesting journey. It's an entrepreneurship within the safety net of organizations, but some of the similar challenges about making decisions and how to grow a practice are akin to what my clients are dealing with in growing their businesses.
Awesome. So let's start with then what kind of mistakes, 'cause you mentioned this at the top of the show here, that most people don't know what their business is really valued at. What are some of the mistakes some business owners, entrepreneurs make when valuing their business?
So I actually recently published an article. It was a top 10 list, the top 10 mistakes business owners make. I actually had to add a couple since I published it. It's now called the top 12 mistakes because I keep finding more and more things.
Uh-huh.
I'm always amazed to see the new and creative ways that people can just go sideways in thinking about it. So I'll give you a couple of the highlights.
Sure.
One, for example, is that a lot of folks don't really understand that valuation is a forward-looking exercise. They're constantly focused on because they hear it everywhere. You know, what's your company worth? It's a multiple of EBITDA, and
Right.
most business owners don't know how to spell EBITDA, pronounce EBITDA, or even know really what EBITDA means. Then, of course, there's a nuance of what goes into it. So, for those who are listening who may not know, it's earnings before interest, taxes, depreciation, and amortization. And it's a neat little metric that we use to put businesses on an apples to apples basis.
Mm.
Um, and companies trade at multiples of EBITDA. It's a profitability cash flow proxy. Um, but it's not just about what did you do in EBITDA or even sales last year or the couple of years before that. If you've ever watched Shark Tank, Dragon's Den, you hear the investors ask, "So what are you going to do next year and the year after that?" And
Mm.
that's because buyers and investors are buying the future. So if you've got a company and you've done really well the last couple of years, but you're facing some headwinds next year and the year after that, maybe you've lost a key customer, maybe there's some uncertainty about growth in your particular industry, that's going to have an impact on what the multiple would be for your current EBITDA. So that's one example of where or business owners can go wrong in doing that. Another thing to think about is as they are thinking about the future and presenting perhaps a business plan to a buyer or an investor, I've seen what we refer to as the hockey stick forecast, where a company may be chugging along sort of at a nice little clip, a flat line, kind of the base level of a hockey stick.
Mm.
But now that we're going to be talking to a buyer or an investor, suddenly the future looks like they're going to the moon. Um, there's a lot of professional skepticism when people see that type of a projection. So your forecasts have to be really solid in their underpinnings. And then the last one I'm going to share with you, which is one of the additions that went from a top 10 to the top 12, is there's just so much bad information out there on the internet, Mac. People
Mm.
think if you're sniffling, you go to WebMD and you diagnose yourself, and it's dangerous to do that.
Right.
I actually saw somewhere where a business owner recommended you don't need to get a valuation to know what your business is worth. They allege that it's too expensive and too time consuming. And I would tell you that neither one of those is true if you're working with the right partner. But they go on to tell the reader that the only way you need to think about valuing your business is go to this website here, identify your industry's EBITDA multiple, and then multiply it by your current revenue. And I did not just misspeak there.
Really?
Yes, they said go grab an EBITDA multiple and multiply it by your sales. Yeah,
Wow.
exactly. So don't do that.
All right. So listen, let me just pause here a moment. Let's get this right. And I'm going to put some numbers in there and we just chunk it down so people can get it. So let's imagine that your business is doing, let's ease of numbers, a million a year. And EBITDA basically, you may have heard of not net profit, but it's actually more than that. There's a lot of things that go with it. So let's say your EBITDA, just for now, we say the EBITDA, which most people understand as net profit, as I said, there's more to it than that, is 200,000, right? 200,000 is, and some people say you can sell your business at 3 times multiple, 8 times multiple EBITDA. So let's say it's 3 times 200,000. That's 600,000.
Right.
Now, some people understand that, but what you're saying is some ridiculous people have the notion is times it by the revenue. So
Yeah.
I just wanted
So
people just to catch up as to what the EBITDA is, and then we can take it from there so we don't lose anyone.
yeah, so that's exactly right. On this particular site, that's what the recommendation was. I don't know if it was if they were misspeaking or if this was intentional, but whatever it is, it's out there and it had been out there for a while and
Wow.
hasn't been corrected. Um, so that's the key caveat. Be very careful about where you find your information about how you go about doing these things.
Listen, Dave,
And the
why?
last thing I will share
Yeah, go
with you,
ahead.
if I might, because
Sure.
I'm really passionate about this one,
I
because
see.
I talked to you about this before we hit the record button.
Uh,
Um, Recently just wrote an article about why ballpark estimates are not a great way to think about the value of your business. And there are certain times where a ballpark can be good enough if you're thinking about, go forward or don't go forward with a certain thing. But I was sharing with you, and I'll share with your audience, recently had a situation where a business owner had a 50% interest in a very meaningful sized business. I think it was like 60 million, 60.
hmm.
And his partner wanted to buy him out. And he was very content using online calculators to get a ballpark estimate rather than spend a few bucks to get the real answer. And I can tell you firsthand from seeing and working with the online calculators, they leave a lot to be desired. And he's either not going to get what he truly deserves for the value of his shares, or his partner's going to wind up overpaying, which certainly is a net benefit to him. But at the end of the day, they're going to figure that out, and there's going to be a big conflict. So that's the other thing I just wanted to
It's a
share with you.
great point there, and I want to lead to a question as to why do people scrimp on paying for good advice, a good consultant, when it comes to making big decisions like that. And I look at it from my own perspective that many people say to me, "Why do you have this tax advisor? Why do you have this CPA, this accountant? Why are you spending so?" Well, I want the best of the best. I want people to give me the right information because in the past it's cost me more in the long run by not having the right information. I've ended up paying a lot more in tax. I've paid a lot more to legals to get myself out of situations because I didn't pay for the right advice legally, tax wise, financial wise in the past. So why should people really reconsider and think if I'm going to make this bold move, this big move, I should get the right person to advise me here.
Yeah,
And
it's funny. There's a theme here. So I've got an article about that at how not to select your service provider, the high cost of low price. What happens is, and all these are available on my LinkedIn profile. What happens is when I go through these situations, I feel compelled to try and put something in paper to share with people so that they don't continue to make these same mistakes. I get inspired. Read that as agitated. The answer to the question, I think, and I've struggled with this throughout my career, it's a couple of things. Number one, especially in my space, nobody wakes up tomorrow and says, I want to know what my business is worth. Wait for it.
Mm,
And they're willing to spend, 10 or 20 grand or whatever the number is to get the answer. usually they're trying to do another thing. And the other thing could be maybe they're buying a business, maybe they're granting stock options, maybe they want to gift some shares of their company to their kids, or maybe they're going through a business divorce. There's a lot of reasons why people need a valuation of their business, but
Mm,
they're trying to do that other thing. And in the process of trying to do the other thing, their accountant or their lawyer or their money manager will say, before you do the thing, you need to get your business valued. Client goes, oh, great. Who do you know that does that? So the accountant or the lawyer hands out three names, and they give out three names because they've got the fear of the negligent referral. And the idea there is, and I know this because I've spoken to all of them, it's 100% true. If they give one name and they say, hey, you should work with Dave, he's great. And
mm,
this is the job where Dave screws up, it washes up on their shoes. But if
right.
they give three names and the client chooses to work with Dave and Dave screws up, well, hey, not my fault. I gave you three names. You picked him. So when people get three names from their accountants and their attorneys, there's this element of trust that comes with it because there's a presumption that, well, if they're giving me three names, well, they're all equally qualified. They all must be just the same,
Right.
but we're not. And you've got to dig deeper and ask better questions and go through a better thought process in making your selection, because a lot of times if people can't distinguish between quality and value and price and performance, they default to, well, what's it going to cost? And you know what happens when you default to price. If you've got one bid that is way off the mark, let's talk about a house painter, auto mechanic, whatever it is. When you've got that real low bid, you know something's not right here, right? And you kind of push that one to the side. But in our world, in professional services, they're like, look at them. They're the cheapest and they're all the same. I'll go with the cheapest. But like you said, you get what you pay for, and you wind up paying multiples of the savings in damages and litigation. And there's all kinds of things, opportunity cost, time, you name it.
So for those listening in, listen very carefully. If you have a business right now, doesn't matter what size it is, realize that your business, the worth of your business is the value of your business. So, Dave, how does one go about, what are the key drivers, I should say, key drivers that bring the business value? What are the key drivers of business value, would you say?
Yeah. So a couple of the obvious ones are revenue growth, right? So consistent top line growth.
Right,
To the extent that it's recurring, where you've got a sticky customer base and a buyer or an investor can count on that revenue going forward and growth in that sales, that's one good thing. Profitability is another one. So whether it's EBITDA, net income, whatever your measure is, everybody understands the word profit.
right.
Unfortunately, a lot of business owners are taught you want to minimize profit because you want to avoid paying taxes. And then they get to that uh-oh moment where they need to sell, have to sell, want to sell,
Yeah.
and now they're trying to explain why their business really is much more profitable than what their books say. And then you're making these normalizing adjustments. And rather than having to explain it, run your business as if it's for sale tomorrow. Um, and then you'll have cleaner books and records if and when you get to that spot where you do need to think about a sale. Um, so those are a couple of the things, but the key here, Mac, is it's all about risk and return, risk and reward.
Right.
One of the I don't want to get wonky here for your audience, but one of the ways I talked about valuing a business, it's a forward-looking exercise. So the way the math is there, it's called a discounted cash flow approach, where you project the future and you bring back the economic benefits to today's dollars at an appropriate risk rate. And there's a lot of things that go into the risk rate, but to the extent that you can do things that lower the risk of your business. So again, a secure customer base, clean financial records, processes and procedures, things that make you look like a, dare I say, a real business, where the business could run tomorrow if you became ill or you were hit by the proverbial bus. The business wouldn't come to a screeching halt. That you're not just the key person, and it wouldn't go on without you. All of those things and anything that you can do to de-risk your business is going to increase your value.
Fantastic. Dave, in a moment, I want to ask you, why does someone who's thinking of selling their business need your, or even buying another business, need your service? In a sense that when I look at it myself as a business coach, business consultant, why does anyone need my company, my business? Well, one, I'm not attached to your business. I can look at the numbers and I can tell you the truth. Whether you deal with the truth or what I can see or not, it's up to you. I'm not attached to it, so I have no emotion on it. If your outcome is to grow by an extra 20% or 50%, all right, let's pave that out. And then let's have the support, the implementation, the accountability to hit that. And so my coaches work with our clients, hold their hands, and actually help them to stay on the path to that result they want. But why does anyone need your particular service?
Yeah, first of all, it's really important that you're holding people on the path within their guardrails. I see too many business owners that see the shiny object, get distracted,
Absolutely.
and now they're off to the races. Look, by definition, a lot of times business owners and entrepreneurs have the attention span of a goldfish, and if they see something,
You
they're
said,
off to it. So
you
good
said
on you for keeping them focused. Why do people need me? You touched on it because it's the objectivity piece, right? And you want a good objective answer. But think about it like a good analogy is if you're going to sell your house, why do you hire a realtor?
Mm,
I can tell you that I thought of myself as a smart enough guy that I could sell my own house. This was a long time ago. And I
right.
actually tried it, right? Why should I pay the commission? Because I can just do it myself. And I learned the hard way. It's just not something that I was really skilled and capable to do. Didn't have the time or the bandwidth to do it. If you've got an important thing that's happening in your life that involves your business, and by the way, it's probably your most important and valuable asset that you don't even know the value of. But if you look at your personal balance sheet and think about whatever the value of your business is, it's probably a glaring number one most valuable asset. So, kind of important that you understand what it's worth so you can make informed decisions about it. Um, but you mentioned, so if people are thinking about selling their business, and I want to touch on that one because I get those calls a lot. I'm thinking of selling, I need evaluation.
Mm,
If they're thinking of selling a couple years down the road and they want some good advice on what's the business worth now and how can we get them to a spot where we can maximize their valuation at a sale, get them ready, that's a great conversation that I can have with them. If they're in the uh-oh moment where the for sale sign has to go on the front lawn for whatever reason right now, they don't need me. And I'll introduce them to someone who can help them sell their business. At that point, it's too late. And my conceptual value of what somebody might be willing to pay, uh, well, it may be well documented and supported. The reality is, if you're going to put the for sale sign in the front lawn immediately, then the market's going to tell you what you're really worth.
right, right. One of the things you say is you talk about return on in, sorry, you talk about ROI, and most people know that as return on investment, and that's true. But also you go on further to talk about return on individuals. And I just wanted to extrapolate that out a little bit more. You touched on it about people within the business, but how does that equate when it comes to valuations, business valuation?
Yeah, thanks for bringing that up. I personally think that people are really the last bastion of value creation. The new ROI, return on individuals, is something that, well, it's a book. There's a second book, the new ROI, going behind the numbers. I never intended to write the book, Mac. I intended to just basically write an article that was born out of, again, frustration. Um, One of the intangible assets and IP assets that I valued throughout my career, among other things, is people, human capital,
Mm,
and never really thought that my profession gave the best rigor and commitment to fleshing out the true value of people. And I'll ask you and your audience sort of a rhetorical question, but every CEO on the planet pounds the table and says our company are our most valuable asset. But do you know where that most valuable asset sits on a financial statement?
mm,
Well, spoiler alert, it doesn't sit on the balance sheet with assets. Okay, most people think of people as an expense, salaries and benefits.
mm,
So I decided I was going to write something about it, and that one article wound up becoming a series. At the time, I was also publishing as a contributor to the business section of the Huff Post. So it generated some interest, and people started to show up and ask me, "Well, what are you going to do next? I didn't have any thought in mind because again, that this was just a one-off thing because I needed to get it off my chest. And it became my journey to discover and prove that people really are an organization's most valuable asset, which I truly believed. And the the key takeaway that your audience needs to understand here is that there is a lot of empirical data that I've discovered along the way that genuinely proves the impact that people have on the value of your business. And you can think about it in the context of, just for one example, turnover. When you lose people, there's the actual cost to replace them, and then there's the the intangible cost of replacing them, all the institutional knowledge that walks out the door, which is multiples of their salary, right? So there's that one component. But more importantly, if you've got an engaged workforce, if you're a good leader and you can generate engagement among your team, you're going to get people who show up every day to give you their best effort. And maybe they go above and beyond, the extraordinary stuff. That's where the great ideas come from. That's where the innovation comes from. And that's what's going to drive profitability. That's what's going to drive sales. That's what's going to make your organization one where people want to come and work because they're going to be your brand evangelists. And as we all know, your people can make you or break you.
Oh yeah, definitely, definitely.
So harness it, treat people the way you would want to be treated, and watch what happens.
A great point, because that has a if you have a happy workforce, that has a direct correlation to the productivity and the performance of the operation of the company. And so what I'm hearing you say is look after them, lead them correctly, have the right culture, and it will translate into numbers, positive numbers. Is that what we're saying?
Yeah, and look, it's not just me that's saying it. There are people who are way smarter than me, and I'm going to give you a couple of examples. So, all the companies that are doing the right things that are recognized with awards like Great Places to Work and things like that, those companies enjoy a lower cost of capital. So
Mm.
remember I told you that the value of a business is the present value of its future benefits brought back to today's dollars at a risk rate. That risk rate is the cost of capital. So the way the math works is if you've got a lower cost of capital than your competitors, your valuation is higher. That's the way the math works. The lower the cost of capital, the greater the value. So that's the wonky piece. I'm going to give you one more thing that your audience can certainly check out and verify on this one. But there's a group called Harbor Capital, and they run a group of mutual funds and ETFs. And they've got some funds that are predicated on the thesis of identifying companies that are doing great things with their people, treating them right. They've got great cultures. It's an investable thesis, and their returns demonstrate that the companies that are doing the really good things around employee engagement and building those kinds of workforces outperform their peers, and you can invest in it if you really believe the strategy. So their numbers speak for themselves. It's all connected, man. If you can get your head around it as a leader, that if you do the right things around building a great culture, your people will show up as engaged employees, and it will drive your business value.
That makes a lot of sense, especially the way you've put it there, Dave. Fantastic. Dave, so can you give me one or two examples, maybe extremes, two different extremes, if you like. One, the small business owner who is forward thinking, who's set up their business, it's doing relatively well, but they've had the foresight that they've said, my exit strategy is this. This is where I want to be in 3 years' time. Let me speak to Dave, and Dave now paves a path for me to hit that. That's a forward-thinking entrepreneur. And then the other one may be an example where someone was very much last minute and they really couldn't capitalize on what their business could have been sold for had they had a foresight of working with you 2 years or 3 years prior. So they didn't realize the amount of money at the sale, if that makes sense. I just want to give our audience some ideas of where Dave makes a
Yeah.
difference to
Yeah.
your business valuation.
Yep. So the first example where you've had the informed business owner, I would analogize that as you were saying it. The thought came to my head. It's like you're going in your car and you're going somewhere that you've never been before. So you punch in the address into your GPS, your navigation system,
Hmm.
and you get step by step directions. And if you make a wrong turn, your navigation system will reroute you so that you get to your destination. Begin with the end in mind. Eventually, there's going to be an exit. And if you're prepared for it and you plan for it, you'll have a much better outcome. Somebody once said on a panel that I was attending that you may not be for sale today, but you can always be bought. And I see that a lot where
Hmm.
clients get offers from companies and they have to react to it. So if you're prepared for it, you're going to be well better served. For those companies that have the uh-oh moment where now all of a sudden they're forced to go to market, uh, again using the house analogy. So imagine you're in a situation where you get relocated, or there's a death in the family, and now you've got to unload this house, and it needs carpet, it needs paint, the roof is a mess. there's a whole litany of things that people are walking through and making comments about. Had you had time, you could get all of those things repaired so
Right.
that when you actually put the for sale sign on the front lawn, you were ready to go to get the most for that piece of property. It's the same thing in a business situation. Get yourself ready, be prepared, have a plan, have an end in mind, and work towards that.
Absolutely. Excellent. Thank you so much for that. Dave, for those who want to learn more or catch up with you or connect with you, what would be the best way for them to discover more?
Oh, so many ways they can find me. Thank you for that. They can connect with me on LinkedIn. I'm always happy to chat with people. All those articles and many more are out there on my LinkedIn profile. The new ROI, the books, you can find more information about those at newroi.com. Books are also available wherever you get your books, Amazon, etc. I also host a talk show called Behind the Numbers. It's a podcast that's listened to in more than 100 countries, and you can catch that anywhere you get your podcast. And you can also find me at Hafley Flanagan's website at hfco.com.
Awesome. All right, we'll put these at the footnotes of the show. So, in a moment, I want to come back to you to see if there's anything I should have asked you that is important I haven't asked you that our audience need to really know. So, whilst Dave is thinking about that, I want to say, listen, put some questions into the chat box or put some comments into the box, whatever platform you're in, and also make some comments. Let us know what you got out of this. What were some ahas or breakthroughs for you that will make a difference if you follow through on? And as you know, the algorithm loves engagement. So please feel free to share, make, gives us emojis, whatever it is that makes sense to you. Dave, over to you then. Is there something I should have asked you that I haven't asked you, but still relevant and important?
I think you covered so many great things. And I guess the only other thing that I would just offer to your audience is I am always happy to have conversations with people. I don't push, I don't pitch. I've seen a lot in my career, Mac, and I know that I can usually save people some heartburn just by hearing them out and giving them some advice. And there's no charge for that. So my offer to your audience is don't hesitate. Message me on LinkedIn. Do it on this platform, wherever you find me. Feel free to reach out and know that I'll be giving you my best counsel. Whether we work together or not doesn't matter.
Superb. Dave Bookbinder, all the way from New Jersey, USA. Dave, I want to say thank you for jumping on to give us so much of your valuable knowledge and insights. Thank you so much.
It was my pleasure. Thanks for having me.
You are most welcome. All right. Until next time, stay tuned and also remember to follow and subscribe depending on which platform you're on. Thank you so much.